Okay, well, today, quiet class. It's good to see you guys all here. You'll be excited to know that today we'll be learning about risk management. And the students at home who are watching this, they all know about risk management. That's why they're not here. And you guys have to have a strong talk with you. So anyhow, let's see. We'll be learning about a few things today. We'll be learning about the Monte Carlo method for pricing options and pricing other derivatives, which is kind of useful and interesting. And then we will be learning about value and risk management in general. So this is chapters 13 and 16 of your textbooks. So the first thing we're going to talk about is the Monte Carlo method, which is kind of one of the newest approaches to pricing derivatives, and it's actually a really kind of a smart and an interesting approach. So Monte Carlo methods have been around for a while. It's basically a simulation approach to pricing derivatives. They've been around for a while, but not necessarily applied to the world of finance. So in 1977, this method was, they first came up with it in order to price complex derivatives. And so basically the idea is that we just simulate price paths for an underlying and then price a derivative based off of that. And so it's a very useful method for very complex derivatives, okay? So it's not, I would say that it's definitely sort of the last method you would go to use if you're trying to price derivatives, but it's a good approach, but it doesn't have many of the benefits that our other approaches like binomial tree and Black-Scholes have. The main benefits associated with those methods are that not only do they tell us how to price an option, but they also tell us how to hedge it, right, using the delta hedging approach. And it's almost the type of derivative that you can't hedge is the type of derivative that you would price using this method. So, and I guess I should point out, like, my gambling images up on the screen. The reason for this is, of course, that the Monte Carlo method is based on the idea of just a probabilistic approach, like a casino type approach. So let's explain that very quickly. So we'll say, for example, if you were to roll 2 dice, okay? You could work out the probability of rolling various outcomes, like you could roll 2 ones, we'll call that a 2, you could roll a 3, 4, 5, 6, 7, all the way up to 12, right? Does anyone know what the most likely roll you would get if you roll 2 dice is?
8 or 7?
7. It's 7, and the reason that it's 7 is just because there's more combinations that will get you to 7 than anything else, okay? So with a 7 you can roll a 1 and a 6, a 2 and a 5, a 3 and a 4, and so on. And so there's more ways of getting to 7 than anything else. So if we think about that sort of simple probabilistic idea, there's a few ways that you could work out the probability of rolling the various outcomes you could get from rolling a dice. The one approach is the mathematical approach, which is a little bit like the approaches we've used up until now to price derivatives, where you simply calculate a fair value for dice rolls, for example. Now, that's one approach. Another approach is just to get 2 dice and to keep rolling and rolling and rolling them and writing down what you get, right? And that's a brute force approach. There's no mathematics involved. You just do it over and over again and you note down the outcomes, right? And that's sort of a simulation way of working out the probability of the various dice rolls. And that is kind of what the Monte Carlo method is for pricing derivatives. So instead of having an awful lot of financial theory underlying it, it's really just a brute force approach where we essentially are doing the same thing as just rolling a dice 10,000 times and working out what the probabilities of the various outcomes are. So In valuing an option on an equity, the simulation would generate several thousand possible but random price paths, and then you basically average the payoff. So you look at like where the option could have gone. You then say, well, that's one price path. If it had followed that price path, the derivative would have expired with this value. And then you just do that over and over again. So it's essentially just running a random number generator to generate these price paths, see what happens with the underlying, and then present value. Now, hopefully you can already see where that could be reasonably useful. Because if we have, there's certain types of options that we have that are path dependent, you know, where it's not just where it ends up at the very end that matters, but it's how it gets there. And in next week's class, if you're all here, we'll be learning about exotic derivatives. And in that class, you'll see there's a number of path-dependent derivatives, and with that kind of derivative, the easiest way to price it is probably the Monte Carlo method. So that's really all it is. It's sort of a simulation process that we follow. So visually, I've just put together this image, which of course is a bit too dark for you guys maybe to see. Next year, I'll try and improve it. But essentially, each of these wiggling lines is just meant to be a price path of the underlying. So you just generate thousands of these, and then you work out what our option would have been worth at the end. And then, of course, you present value it, because in finance, you can never get away from present valuing things. And that's really it. Do you guys kind of get that? Do we all understand that? Does anyone have any questions? I know it's a crowded class, it's often hard to ask questions, but do feel free if you're, if I'm going too fast or anything. Okay, so when or why might we use this? Well, the best use for this is if we have to price complex options that we can't price with our traditional methods, like the binomial tree or the Black-Scholes. And so, in truth, they are always our first stop, simply because they do give us this, suggested approach to hedging the derivative, the delta type approach. So that's always more attractive, because the truth is the kind of thing that you can price using or that you can only price using the Monte Carlo method is the kind of thing that's going to be close to impossible to hedge, right? Because if there was a hedge, there'd be another way of pricing the derivative, right? And so they tend to be sort of unhedgeable derivatives that you're often pricing with this, and usually an unhedgeable derivative, in order to encourage someone to sell something that they can't hedge their risk to, what are you going to have to do? That's correct, you're going to have to pay a lot, right? Because basically someone is exposing themselves to, a great risk. Great financial risk. So, what is it used for? So, you'll often see it being used in things like project finance. So, a few weeks ago when we learned about real options, you'd often use Monte Carlo to price a real option rather than using. In the class we talked about Black-Scholes and binomial tree, but usually you'll find what people do is they just run a little Monte Carlo generator. You can either code, they're actually really easy to code up, or you can, you can often just get I think there's an extension for Excel that will allow you to run Monte Carlo price paths as well. It's also used for, what else? So very complex options, things like real options, portfolio evaluations, where you want to not only model you not only want to model the price paths of underlyings, but also correlations, right? And so the beauty of this method, it's worth noting, one of the things that's kind of cool about the Monte Carlo method is you're able to put in all kinds of different distributions. You can put in all sorts of different correlations. You can make everything change, right? You can have a volatility that has a volatility itself. You can have different distributions, you can have different correlations, you can have correlations that change over time that relate to volatility. Like you can really mix it up as much as you want, because you're just generating random price paths. It's also been used in personal financial planning. You'll sometimes find these sort of online tools for calculating, the chance of retiring at a certain age, a certain income, that kind of thing. And so that's what it's used for. In truth, like mostly pricing complex derivative stuff. So we really need it when there's kind of 3 or 4 sources of uncertainty. So the price path of the underlying is one source of uncertainty. Volatility might be another. But once we get too many sources of uncertainty, we kind of reach this point where there are no partial differential equation methods like the Black-Scholes that we can use. The binomial tree won't work. And so you're just left with only one approach, which is the Monte Carlo method. And like I said earlier, it's a brute force approach. It's kind of like, it's not necessarily the easiest way to work out the probability of various dice rolls, but if you've got the time, it will work. It'll do the job, So in these cases, Monte Carlo will get to a solution much more quickly than numerical methods. In the old days, in a lot of the older textbooks on financial derivatives, you'll see people saying that the problem with the Monte Carlo method is that it's too slow, because it uses a lot of computer power. That they were books that were written in the 1990s, when the computers didn't do that much. Nowadays, to be honest, your mobile phone probably has the power to run a decent Monte Carlo generator. That's not really the issue that it used to be. For those of you who are interested in this approach, this is the book that I learned to write a lot of kind of financial code in. If you're learning, I guess there's probably newer books, like this is a book that's sort of 10 years old, but code is code as well, it doesn't change. This is a pretty good book for how to write, pricing models, right? So if you want to code up a Black-Scholes, a binomial tree, Monte Carlo generators, all of those sort of derivative pricing tools, and that's a good way to learn a little bit of code if you have the free time. Unfortunately, it's a bit of an expensive book. I think at least it used to be. It cost about $100 and sort of this thick, but it is actually a good book. So what else have we got? So once again, there are YouTube videos, and this video will hopefully be available on YouTube in a little while. I'll probably make this a private video. So equity options can be multiple one source of uncertainty, which is the price of the underlying stock. Stocks are usually modeled assuming that they follow geometric Brownian motion, as we've discussed in prior classes, with constant drift and volatility. So that's sort of the assumption that we have in our Black-Scholes and binomial tree approaches. Interest rate options can use Monte Carlo to randomly generate different yield curves, right? So once again, the advantage Monte Carlo gives us is we can add in a ton of complexity, and that can be cool, but there's always sort of that question is, does a ton of complexity actually improve your pricing? And that's not necessarily always the case. It can be used to value options where the payoff depends on multiple underlyings. So things like basket options, where there's a bunch of different underlyings in a basket of securities, and we'll cover those next week in that class. Monte Carlo simulation can be used with any type of probability distribution. I mentioned this earlier. So you can put in any probability distribution you want, including changing distribution. So it is kind of quite an interesting approach. What else? So it's particularly useful for options with multiple sources of uncertainty, widely used in valuing path-dependent structures like look-back options and Asian options. And they are options whose payoff depends on the price history of the underlying, and we'll cover that in exotics next week. If an analytical technique is available, because the one thing I would say, like when I teach about the Monte Carlo method, it is kind of cool, it's really interesting, Students often get really excited about it because it is kind of cool like that, but the one thing I would leave you with is that if an analytical technique is available, it's usually a better approach. Monte Carlo method is usually thought of in the industry as kind of the method of last approach, like it's what you go to when none of the other methods work. Does that make sense to you guys? Mm-hmm. Is everyone happy? Okay. So that's kind of it on Monte Carlo method, and as you can see, it's not overly complex. It's not like it took us kind of 2 weeks to go through some of our other pricing models, and it took about 20 minutes to explain that concept. We'll now move on to risk management, and in particular risk management of portfolios that contain derivatives. Now, have you guys already have a class on risk management as part of your masters? Or?
Mm-hmm.
Yeah, and how do you find it? Is it interesting? Or?
Yeah, interesting.
Yeah, okay. Well, hopefully my goal is to not overlap with the class you're already taking, because then it would make my class pointless, and that's a nightmare to me. So what we're going to try and do is we're going to really just concentrate more on risk management of slightly unusual portfolios, and that means portfolios that either have active trading in them or that have derivatives exposure. And both of those things will change risk management, because a lot of the kind of more basic ideas of risk management are kind of tied to this idea of you have an investment portfolio, nothing about that portfolio changes, and it's filled with assets that, while they're maybe not, normally distributed, they're closer to that than a lot of our derivatives are. So, risk management, I guess, the title of this is Creating Economic Value by Assessing, Mitigating and Monitoring Risk. And it's kind of an interesting time to be teaching a class on risk management when, we've had one of the more shocking markets I've seen in a while. We've had the futures are limit down as we speak right now, second time in a week, which is unusual. And so risk management is obviously something you'll be reading a lot about in the press in the next little while. But it's an important point here that says creating economic value. And sometimes within certain financial institutions, risk management can be viewed as kind of a boring thing, a guy who goes around and kind of spoils the fun on the trading floor, if you know what I mean. And that's very much not what it is, or not what it's meant to be. It is supposed to create value, so it's not supposed to destroy value, it's supposed to create value, and it's tied to this idea of working out what the risks are and how they can be managed. And so obviously within not just a financial business, but any business, people are taking risk, right? Like if you own a barber shop, you're taking risk in that you're paying rent every year or every month, and you're hoping people will come in and you'll be able to charge them a fee for a service, So there's risk in almost any walk of life. Like you guys are students here at King's College. You took a risk by taking a year out of your work life in order to study here and to hopefully increase your marketability in the years to come. And so once again, hopefully, and it's a sensible risk to have taken. So what is risk then? Well, if we're going to talk about risk management, we need a definition of risk. And the problem with definitions of risk is there's just not one of them, because everyone thinks about this idea a little bit differently. So we've got 4 definitions up here on the slide. Our first one is it's the potential that a chosen action or inaction leads to an undesirable outcome. Okay, that's probably a reasonable idea of what a risk is. Potential losses can also be called risk. The probability of a hazard resulting in an adverse event times the severity of the event. So that's kind of a useful definition where we're saying it's probability times severity of outcome. That's kind of a decent definition. And finally, we've got here future issues that can be avoided or mitigated. And of course, that's important, right? Because what we're trying to do with risk management is we're trying to see the risks that we can possibly avoid in a sort of economically sensible way, right? Because sometimes there are people who are maybe a bit over the top on the idea of risk management, and their idea is that no risk should ever be taken. But of course, we do have to take risks in our daily life. Like we get out of bed in the morning and make ourselves a cup of coffee, and we risk burning ourselves with boiling water, for example. But it's a worthwhile thing. And so at most financial risks, people are taking financial risks because they are worthwhile, or at least they're perceived to be worthwhile. And that then brings us to our next slide, risk and return, because of course these two things are tied to each other, right? Like a person usually wouldn't take a risk without an expected return. And then there's an awful lot of ideas that we look at in finance, things like Sharpe ratio and Sortino ratio, that try to tie together this idea of risk and return because they are very much related to each other. So we know what expected return is. It's the weighted average of likely payoffs of an asset. And that's kind of almost every pricing method we've used in this class to price our various derivatives are essentially the weighted average of the likely payoffs of an asset, right? Like that's what we've been doing in the last few weeks. Then risk is the chance that the actual return might be different to the expected return. Now, if we think about that for a second, we're not saying, at least in finance or as we're in mathematical finance, we're not saying here that risk is losing money, which is kind of how most of us think about risk. But in finance, we're actually saying it's the risk that the return might be different to the expected return. And if you think about when we then move on to saying variance or standard deviation are used to measure risk in finance, what does standard deviation measure? Can anyone tell me roughly like a quick definition of standard deviation?
Well, it's the diversion from the mean.
Exactly. It's that bell curve where there's a variety of outcomes. The mean return is the expected return, so that's our expected return up there. And basically anything that's not the mean is sort of part of that dispersion or that standard deviation. And so with one standard deviation, you can expect about 68% of the outcomes in a normal distribution to be either one standard deviation greater or less than the mean, right? And so essentially what we're saying here when we use standard deviation as a measure of risk is this idea that it's kind of like if you're throwing a dart at a dartboard, you're trying to hit the bullseye right in the center. We view it as a risk that you would hit any area other than that bullseye. Now, there are certain parts of a dartboard that have an actual higher value than the bullseye. It's not the highest value part of the dartboard, but that's still a risk that you'll hit that. And so equally, you can see, if we're going to use standard deviation as a measure of risk, that doesn't just include losses, it also includes surprising or unexpected gains, right? So if you invested in a stock and you expected it to go up by 10% a year, you might think about the risk is that it will fall by a certain amount, or even that it won't go up by 10% a year. But part of that standard deviation, a concept of risk, is that if it goes up by 10,000%, which is obviously a favorable outcome, that is still being encapsulated in your calculation of risk when we use standard deviation. So, can anyone tell me why we use standard deviation in finance as a measure of risk? Because there's a bunch of things. We could just say probability of not making as much money as we wanted to, or even probability of losing over a certain amount of money. Like, why don't we use those approaches?
Is it because it's standardized? Or
You're going very much in the right direction. It's largely that it works very well within formulas. You know, if you're going to build all of these financial formulas, you can't have kind of a quirky measure of risk. And actually, within that sort of standard deviation bell curve, it does encapsulate, you know, because that's what a bell curve is, it's encapsulating like probabilities of losses and so on. But it is worth, you know, there's often a thing like where finance students, you know, people look at formulas, you know, a lot of people are taught a formula and they're told, you know, the first week of your finance classes and they go, what is risk? It's standard deviation. Students go, is it standard deviation? Professor goes, it is standard deviation, remember that. And then sort of a few years later when they graduate, they go around and go, risk is standard deviation. And you know, we have to think about everything. Like one of my goals here is that we all think about these formulas and think about why we're doing what we're doing. And that doesn't mean like, the formulas aren't perfect and they're not terrible, but you know, there's, I guess, risks associated with the formulas as well as everything else. And so hopefully you guys will all understand that. So if we now defined kind of risk and return, that then brings us to what is risk management. And this is the definition that I sort of mulled over for ages and I think finally put into the book, which is the identification, assessment, and prioritization of risks, followed by the economical application of resources to minimize, monitor, and control the probability and impact of, it's long-winded, isn't it, of unfortunate events or to maximize the realization of opportunity. So there's a lot tied into that idea of risk management. It's kind of not, it doesn't roll off the tongue easily to say that that's what it is. But it is worthwhile noting what we've got going on. So firstly, it's about spotting risks. It's then about prioritizing risks, right? Where you want to take the biggest risks and worry more about those than the small risks. And often there is, you know, prioritization is actually something that's hugely important in almost every part of business and finance, right? Like I had a conversation about a week ago with a friend of mine who argued that if everyone worked just as hard as they normally work, but prioritized better, like just took the really important things and dealt with them first, we'd all like probably be 10 times more productive than we are. But instead, you know, we often drift off and do these sort of pointless tasks. And so within the world of risk management, that's an important point as well, is that it's important. You never know what the biggest risk will be. For example, a month ago, I didn't realize that I'd be sitting in a half-empty classroom with people worried about an illness that's going around the world. So you don't know early on what a risk is, but you know, so you won't necessarily prioritize correctly, but you can still prioritize based on the information that you have available at a given point in time. And so then the next thing there that I always like to focus on is this idea of the economical application of resources, you know, because it's not, you don't throw all resources at every problem, because that doesn't make sense. In the same way, the way you live your life, you don't identify a problem and sort of allocate all of your resources towards getting rid of it. You have to kind of weigh the probability, you know, how important is this and how costly should it be avoiding this risk. And there are some risks that people just have to take. Like back in our class, what was it, on foreign exchange derivatives, and we were talking about the idea that, you know, a company might find that they are exposed to, even if they have a very single country centered business, they might find that they are exposed to foreign exchange risk just because they have foreign competitors. And so we said, you know, that it is worthwhile that business person being aware that they're exposed to risk, but then we said they probably shouldn't do any real hedging just because they might have competitors in 300 different countries, and you can't, you know, the economical application of resources doesn't relate to hedging 300 different currencies in order to manage a small business, right? And so that's really kind of where we're trying to go here with risk management, is that there's two sides of it, and sometimes it's an interesting thing because often people either think from an investment point of view and they just think of, you know, what's my expected return, or they think from a risk management point of view where they say there are risks, we must avoid all risks. And you know, the truth is somewhere in between, right? And that's you know, as I've said, human life wouldn't go on if we didn't take risks. You know, you wouldn't get in an airplane if you were managing risks, right? You'd dig a little hole in your back garden and you'd live in it, you know? And so, so there we go. Now, this slide here, I actually just pulled this slide, or this image, from Wikipedia, and it's an image of the space station. And the whole reason I just have this is to think about like this idea of prioritization of risk. So if you look at this, they basically, the coloring relates to the probability of impacts from greater than 1 centimeter debris in space. And what they've done is the blue stuff is low probability and the red stuff is high probability. Okay, so this is a risk management approach, right? Because it's expensive to send parts up into space for the space station. It's complicated, it's expensive, it's difficult. And so NASA, or whoever, I guess Russia as well, have built this space station. And it probably makes sense to worry most about these red areas on the chart rather than the other areas. And that's kind of what you're doing with risk management, is you're identifying the biggest dangers, prioritizing them, and then focusing upon those issues. So, this is a slide that you'll be glad to hear you don't have to read, but I received this as an email a little while ago. From, who's it from? It's from Ernst & Young. And this is a slide about the elements of privacy, risk management, and compliance within a financial firm, okay? And the reason I've got it up here is just to show you how complex just a simple idea like privacy risk management is. And of course, privacy risk management does matter a lot. And it matters more and more in this day and age. You know, you see issues like there was, it's probably a long time ago now, but there's the big grocery store, kind of general store in the United States, Target, a number of years ago had someone hacked in and took a load of credit card information. And, you know, there's a risk, there's a whole bunch of problems. One is if someone gets, you know, if someone's loses money due to that, they can possibly sue Target. That's one issue. But also there's just the damage to the brand, right? Like when you go into Target and you swipe your credit card, you might worry about that and you think, gosh, you know, it happened at this store, not at another store. Are they sloppy, right? Well, within the world of finance, there's probably nothing that could be worse than appearing sloppy, right? Like you're not going to deal with an investment bank that you think has questionable IT systems, or, you know, a bad firewall, or is likely to be hacked, or whatever else. And there's a ton of regulation around this because, you know, in the new day of like, you know, social media and so on, there's a ton of data out there. And in the past, people didn't really care about this data. But for one thing, it's become very valuable. And for another thing, it's rather questionable, you know, what certain firms are doing with regard to our privacy. You know, like does a store that you deal with, like should they sell on the information that you bought a watch from them to another watch store that can then sort of send you marketing materials, or is that unethical? And so all of this stuff is a big deal. There's more and more regulation around it. And if you fall foul of this regulation, you could be shut down. You know, it's not a simple issue of even being embarrassed in front of your customers or having a bad newspaper article out there. You know, regulators like the SEC and the FCA will shut your business down if you do the wrong thing. And so even there are issues with when you receive emails, you know, firstly, in a financial firm, every email you send and receive has to be backed up and saved. I forget for how long, it's like 7 or 10 years or something like that. And you have to do that. And if you don't do that, they can shut you down. But on top of that, there's even like when you store information on people, you have to have a good reason for it. You know, so for example, if someone emails me a CV and I am not hiring at the time, I am supposed to delete that CV. I can't have a file of CVs in my computer at work simply because I have no good reason to be gathering this personal information on people, you know. And there is a lot of regulation around this, and that kind of regulation will grow. And so all of this stuff does matter. Now, we're kind of done with this slide, but I guess my point is just that if you worked within a large financial firm in the area of risk management and compliance, you'll find that there's almost infinite depth you can go to in terms of, managing risk and kind of what risks a firm might be exposed to. So here we have a slide that is the sources of risk. Yeah, I think this is investment risk. And this is the main focus in our class because this is probably what we're most interested in. But we've got the big ones that are pretty obvious to you near the top: equity risk, credit risk, foreign exchange risk, interest rate risk, inflation risk. Then we get into the ones that not everyone would have thought of, things like liquidity risk, volatility risk, sector risk, diversification, environmental risk, computer hacking, reputation risk, terrorism, full cycle costs, social and health risks. These are all part of what's happening. Like even in recent years, the growth of, I can never think, I hate when things have three-letter names, the socially responsible investing, whatever they call it. In this day and age, that's a big risk for a lot of investment firms because for years they're used to people just wanting exposure to, they want financial exposure to growing companies. And now more and more people really care about this stuff. And if you're running a financial firm and you don't realize this, you're out of date. You can't. In fact, I was surprised. About a week ago, I was on the S&P website, looking up something about the constituents of the S&P 500. And, the PDF that you download from Standard & Poor's, there was a solid half a page on the environmental assessment of the basket of stocks that is the S&P 500. So even index providers are worrying about this kind of stuff nowadays because that's the direction the world is going in. So, strategies to manage risk. So we have a bunch of ways of managing risk. One is to transfer the risk to other parties, right? That's often an attractive one. Avoid the risk, like just don't do whatever is risky. Reduce the negative effect of risk. So hedge, like reduce the risk. That doesn't mean entirely get rid of it. It means reduce it, or accept some or all of the consequences. And that's actually an important point that we'll talk about in a few minutes. But they are the main sort of four strategies that there will be to risk management. I've got one more point up here, which is the risk of not taking risk. And I've kind of possibly highlighted this already. But of course, it is important to take risk, to take financial risk and all sorts of risks in your lives, right? Because that's also, the things that sometimes, can slow us down or make things worse can equally usually make our lives quite interesting and better. And so if you're going to run a financial firm or basically any sort of a business, you will be exposed to financial risk and to all sorts of risks. And that's worthwhile. There's I kind of added this slide because there was a guy I used to work with many years ago who was kind of obsessed with risk management. And he would put on these big portfolios of stocks and then he would analyze them for all of the risks, and he would hedge out all of these risks. Like he'd say, well, I've interest rate risk, I can hedge that. I've this risk, I've that risk. And you would hedge, right? And so then the problem is that you have this kind of portfolio that doesn't move very much when the market moves, right? So then you need a bigger version of that portfolio if you're going to try and generate a certain amount of profit, right? But the problem with a portfolio like that is that you've essentially put on a risk exposure, you've then stripped away all of the risks that you understand, and you're left with only the risks that you don't understand and you can't hedge, And he's a very nice guy, but I never saw the guy have a single up day as a trader, simply because he was always, he hedged away everything that he understood and was just left with esoteric risk that no one could understand. So What else have we got here? Principles of risk management. Now this is from the ISO website, the International Standards Organization. And this is their list of what risk management should do. It should create value, be an integral part of the organizational processes, be part of decision making, explicitly address uncertainty, be systematic and structured, based on best information, tailored, take into account human factors, be transparent and inclusive, dynamic, and be capable of continual improvement. So I think this is a pretty good list of kind of what your ideal risk management strategy would look like. Some important points up there. One is create value. The idea of risk management is not something that just costs money. You don't go in and shut down the most profitable businesses because you've decided that they are a risk. Sometimes you're in them for good reason. Important points, though, are that it should be an integral part of the processes. And that really means, at any good financial firm I've worked at, risk management is kind of built into all the processes. It's not a separate layer. Like, it's a bad approach to have it as a separate layer where you come up with an investment plan and then you show it to a risk manager who comes and takes it all apart and says it's too risky. That's not how it should work. There's always a risk assessment just from the very beginning, like when you decide that there's a trade that might be attractive. The first question is, what are the risks and the rewards? And you build it in the whole way along. Another important point up here is be systematic and structured. Now, I'm a little bit biased because I run a systematic investment fund, and so I obviously think that everything should be systematic. But I would argue that the good thing about systematic risk management is that it's always followed and that it's always there and it's done the way it's meant to be. You can't really have like an ad hoc approach where you've just hired in a guy who wanders around and analyzes things in a random way. The beauty of the systematic approach is that it's built in and that it's done the same every time and that it can be continuously improved in a sensible way. I have up here that it should be tailored because every firm is different. And a lot of people want to buy these sort of off-the-shelf solutions, and I would argue that often doesn't work because no two businesses are the same. It's a funny thing, when I started my fund a number of years ago, I was, you have to do all of these things. One of them was, you have to put together sort of employee manual, compliance manual type thing, And so what happens is you hire a consultant and they hand you one, and it's entirely inappropriate for the type of business that you're running. And so actually, in the startup of our fund, my partner actually took their one, went through it, decided it was utter junk, and she built our own manuals and our own procedures, because our feeling was that there's no point in having rules that you don't follow, right? Like if you have a manual that says you're going to do a bunch of things that you're not actually going to do, that's utterly ridiculous, So I would say be tailored is a very important point. You don't just take an off-the-shelf solution. And the final point that I would push here is this idea of being dynamic, iterative, and responsive to change. And that's just because things are always changing. And whatever the risks are today are different to the risks from a year ago or from 10 years ago. And one of the great things I learned many years ago, I started out my trading career working for a guy called Victor Niederhofer, who's kind of a famous fund manager in the States. And he used to always push this idea that markets were constantly changing. He would say that you can never have a fixed system, because the problem with a fixed system is that if you're going to go into a market and do the same thing every day, eventually people will spot that you're doing the same thing and they'll work out ways of profiting from the thing that you're doing. And so you should understand that the best example is actually an example from gambling, where you look at, we'll say, for example, if there's a bunch of statistics that you can get on horses that are racing, okay? And we'll say if you worked out, if you're an early quant to the world of horse racing, and you worked out that the biggest horse tends to win the race. You came up with a very simple calculation like that. And so you always went down to the track and you looked at the horses and you always bet on the biggest horse, right? That's a good idea to begin with, but over time other people will notice this, and what will happen is more people will bet on the big horse, less people will bet on the small horse. The gambling odds change, and so then even though you win less, and when you lose more, and so your winning strategy turns into a losing strategy. Now, that is guaranteed to happen in the world of gambling. It's also guaranteed to happen in the world of markets, okay? So any idea you have where you think, I have a good idea, and this will make me wealthy and feed me for the next, for my 40-year career, that's not going to happen, So everything is always changing, and you need to always be changing in order to, to be standing still, you need to be changing. So, prioritization, we mentioned this earlier. The risks with the greatest loss and the greatest probability of occurring should be handled first. And that's probably pretty obvious to you guys. And then as we move down to lower probability or lower losses, you handle them in descending order. Now that's a great concept of risk management. The problem with that, I've included this image of this car that's in a flood and struck by lightning, and the back of it appears to be on fire, in order to ask you guys which of these risks you should prioritize, And the problem with this sort of definition, like, it sounds really good, but the problem is that you don't always know. And so you can't always perfectly allocate resources, but that doesn't mean that you shouldn't try. You should obviously do your best to do that. Risk retention is a very important idea, and that is when you deliberately keep on a risk. Now, you might keep a risk because you think it is likely to be a profitable opportunity, and you want to have that risk. That's one approach. But not only that, there's also this idea of self-insurance, that sometimes if you price up, the cost of getting rid of a risk is so high that you either need to exit the business that you're in, or you need to possibly self-insure. So what do we mean by self-insuring? We basically mean not hedging a risk or not buying an insurance policy or whatever it might be on that risk, and instead just monitoring it and doing your best with it. Now, certain risks just can't be insured against, or the premiums are unreasonable. So, for example, well, even if we think about we'll say if you're Warren Buffett, for example, right? If you're Warren Buffett and you own a car, it's not maybe it's legally required, but if we use our sense, it doesn't actually make sense that people like Warren Buffett and Jeff Bezos and Bill Gates have to buy car insurance, right? Because should they crash their car, they can kind of afford a new one, and they can also afford to make a payout to any injured parties that are probably well beyond the kind of payouts that an insurance company could make, right? So when you buy an insurance policy, it's usually a negative NPV policy, right? The insurance company are only selling it to you at a higher value than it's actually worth, and that's how they profit, and then they're able to offset their risks through the correlation and so on with the diversification benefits. But self-insurance is kind of this idea, but it's an important idea. It doesn't mean just exposing yourself randomly to risks. What it does mean is setting aside enough money that should things go wrong. So for example, if you decide there is a risk that you would like to insure against, but the cost is too high, maybe instead you build up a certain amount of money in savings or in a set aside in order to make that payout should it eventually come about. So that is the idea of self-insurance. So money is set aside using actuarial information that is sufficient to cover the future potential loss. So it doesn't mean just randomly, taking big risks. It means actually managing those. So, history of financial risk management developments. We have a bunch of them up here. The calculation of duration on a bond, right, which is how much the price of a bond changes for a change in interest rates. 1938, okay? people were trading bonds for a long time before 1938. So the whole point of this thing, we kind of see up here 1952, the market's mean variance portfolio, capital asset pricing model in 1963. As you can see up there, an awful lot of the kind of things that we have, that we think of as risk management or useful risk tools, are less than 50 years old, and the business of finance is much older than that. And really what that tells you is that we are still in the early stages of financial risk management, where it's a science that has just begun, and there will be many new developments over the lives of over your careers. So, how much can we lose is a question you might ask as a risk manager, and then I have up here the answer: everything, because of course. Many years ago when I worked in a financial firm, a risk manager came by my desk and they said, look, if we give you $100 million to trade, how much can you lose? And I said, probably not more than $100 million, because that's what I've given you to invest. And, it shouldn't go negative. And he wasn't at all happy with that. And he came back, well, realistically, like on a bad day, how much you can lose? And I said, well, that's a different question. We can discuss that now. But, the truth is, anything can happen. So what are our risk management tools? Well, we've got a bunch of things here that help us to manage uncertainty. So things like insurance and options, because that's what we've learned. Options are a lot like insurance policies. Things like Basel Accords at banks, value of risk, which we're about to learn about. Calculations like beta that just tell us how much a given portfolio should move for a given move in the index, and risk modeling. So these are the tools that are generally used by risk managers. So at this point we'll take a 15-minute break and we'll all right, so welcome back to part 2 of the class. And in this part we're going to learn all about VAR, or value at risk. And so value at risk is kind of a big idea in the world of risk management. And it's an attempt to try and measure risk that can quickly and easily explain it in one number, okay? And so that is both the best thing about value at risk and the worst thing about value at risk, right? In that, it's useful in that you take something very complicated and you make it into a single number that can be compared to that number in previous weeks, days, and months, and so on. But the downside of that is that, of course, the more you sort of compress in, the more detailed information that you lose. Now, the reason this cannot be useful is, well, imagine if you are the CEO of a big investment bank, right? And within that investment bank, you might have 40 different departments. They're all doing different things. And there's some of them that you understand reasonably well. You might understand the M&A business and the equities division and things like that. But then there's all these kind of weird derivative things. There's guys trading like weather derivatives, and there's all this other stuff going on. And the problem is that you may not understand, in fact you will not understand it, right? Because no one is going to understand everything like that. But you want people to report to you numbers that relate to the risk that you can look at, and then should you see that risk is growing in a particular area, or that it's different to how you expected it to be, or there's more losses in an area than you thought there would be, you're then able to dig down, you're able to kind of go by the desk, find out what's going on, find out, have things changed? Is this a good business to be in, kind of thing? And so VAR is useful in that, for a very senior manager who has a ton of things, it's a big number they can look at and know whether things are getting better or worse. But of course, the problem with that is that there's no real detail there. And in using this kind of methodology, you're sort of requiring that person go out and find the detail themselves. But in many ways, that's also their job, so it's not so crazy. So VAR, or value at risk, is defined as a predicted loss at a specific confidence level. Now, people usually talk about 99 or 95 VAR, and that's basically saying, for a one-day period, what is the sort of 5% of worst days likely in a normal market. So if you have a one-day VAR, a 95 VAR of 1 million, that means there's a 5% chance that you will lose $1 million or more in a day. Now, the or more is a really important point, and that's something that people often miss out on when they hear about value at risk. They think that it means that there's a 5% chance that you can lose $1 million. No, the $1 million is sort of a barrier through which you go, and you've got what we call a VAR break, and you are losing that or more. I kind of joked with the last class that it's a bit like, if you think of risk as sort of like the ocean, you know, and there's the top layer of the ocean, and you go crashing through that, that's a VAR break, but you can kind of keep going down and you don't know how deep it is, you know. And so that's what VAR is telling you. It's telling you that you've hit that point of the 5% worst days, assuming markets are normal, right? So that's not actually saying, VAR isn't telling you what a crazy market looks like. Like a market like we have today with, you know, futures limit down and this virus and the oil shock. This is not a normal market condition. VAR doesn't tell you what this looks like. VAR tells you on a regular calm day what your 5% of worst days will look like. And one other thing we have to add in is that it's assuming no trading, right? Because whenever you're trading, the portfolio is changing. And so we'll say, for example, if you're the kind of trader who adds to risk when the market falls, well then VAR is underestimating your risk. Or if you cut risk as the market falls, VAR is overestimating your risk, right? So it's assuming no trading, a static portfolio. So informally, a loss of 1 million or more on this portfolio is expected one day in 20. Now, the reason I put up there that is it's sort of, it's kind of to highlight how that's a little bit wrong. So, that is actually what it is saying, that 1 in 20 days that you would expect a loss of this amount or greater. And there's probably about 20 trading days in a month, right? Because there's 5 days in a business week and about 4 weeks in a month. So we're kind of saying that once a month you'll have a loss of 1 million or more. But it's worth noting that that doesn't mean that they're evenly spread out, that you have one of these a month, okay? And often people think, when they see something like this, they think, so once a month I'll have a loss like that. That's not how it works. Often these losses cluster together, right? So even today, we saw a limit down move overnight in the S&Ps last night. I haven't seen the day market yet. And we had, on Monday, we had a limit down move as well. Those things don't happen very often. These are very rare events. We've got 2 of them in 1 week, okay? So what that is telling you is, you know, VAR, people often misinterpret this idea and think that it implies that there's this spacing out of unusual or bad market events. That's usually not the case, and we'll see a little bit more about that in a few minutes. So where did VAR come from? Well, it came after the 1987 crash. So an awful lot of actually our financial innovation came after the 87 crash, because the 87 crash kind of woke people up as to what a really bad market looks like. It was the worst market that had occurred. Actually, an interesting question though for the class. 1987, what was the year's return for 1987? Was it a big down year? What do we think? It's got to be, right? It was an up year. You know, market had gone up a lot and then it fell horribly, but it was actually an up year, 1987. But, you know, it woke people up as to kind of how fast and far markets could fall, because they'd never moved like that before. And so in the 1990s, internally at JP Morgan, they developed this methodology that's called VAR. And then by 1996, they actually spun it out as a separate company called Risk Metrics in order to sort of offer this methodology to other firms. And it's very widely used at this point. By 1997, there was an SEC rule saying that public companies have to disclose quantitative information about their derivatives activity, and that's when VAR turned up in financial statements. And I don't mean financial company financial statements, it turned up everywhere. And one of the reasons for that was there was a a big scandal with Procter & Gamble where they had a big derivatives loss. I think it was about a year before that. And we'll cover that actually in our final class. Hopefully we're all still here. And anyhow, at that point people realized that, you know, before the mid-90s, people didn't, these derivatives were around, people didn't realize how much they were being used. And suddenly companies started having, you know, big losses. You know, Procter & Gamble is a soap company, and suddenly they lose, I think it was like 200 million they lost on a swap. And so all of a sudden, investors realized that they needed to know more than just the accounts. They needed to know the derivatives exposure of these companies. And so then by 1999, with the Basel II Accord, VAR was put forward as the preferred measure of market risk. So that's kind of where it came from and what's happening with VAR. So what is VAR? VAR is basically looking at the market as being normally distributed, and basically we're looking to the left tail here, and so 99 VAR is sort of the 1%, but VAR is right at that point of that line, you know, so we're saying that once you cross that line, you're in one of the 1% worst days, but that doesn't mean that it stops at that line, just to be very clear. So you've entered the 1% of worst days. And so that's really all VAR is that we look at the returns of a portfolio, or we look at the risk of a business, and we say, what do the normal worst days look like? Not true crisis, but just what does a normal bad day look like? So, if a portfolio manager has a daily VAR of 1 million at a 99% confidence level, that means there's a 1% chance that he'll have a daily loss bigger than $1 million under normal market conditions. And there's always that caveat of under normal market conditions. And we've talked a lot about it in this derivatives class, that markets tend not to be normally distributed. And maybe we'll talk more in a future class about how markets actually are distributed. But essentially there's this issue of very large tails. So, to start, one way of calculating VAR, a rather simple approach, is just to chart the daily returns, right? So these are up days, these are down days. Each of these bars is just a daily return. And basically, if you plot them over whatever period of time you feel is appropriate, and find the 1% of worst days, that's your 99 VAR. If you find the 5% of worst days, that's your 5% VAR, or 95 VAR, however you want to call it. So that is VAR. We can call VAR either 95 VAR or VAR 9, sorry, no, I'm talking backward. 95 VAR or VAR 5%, or 99 VAR or VAR 1%. They both mean the same thing. Usually it's a one-day calculation or a one-day loss measure. Now you can calculate it for any period you want, but usually people are looking, when people casually talk about VAR, they're talking about usually a one-day period. So here's an example of trying to calculate VAR. This is pulled from the textbook. And what we've got up here, this is a chart, I think, of the Vanguard Index 500 fund. So it's the S&P 500, basically. And it's just daily returns from 2000 through to 2015. So 15 years of returns. And as you can see there's a few interesting things about that chart. One of the most interesting things that we're going to come back to in a little while is just this clustering effect, right? Where I said to you, just because it means that, it doesn't mean that the 5% of worst days will be evenly spaced out. And as you can see, you know, the middle there with the big burst in volatility, that's the credit crunch. Back here, 2001-02, that was kind of the bursting of the dot-com bubble, and that was kind of a sort of a normal volatile market, in all honesty. Then things got very low volatile for a long time, and then it exploded. And then we've got here in 2011 the Fukushima meltdown. What have we got there? 2015. There were a few big market moves in 2015 as well. But as you can see, these things cluster together, you know, and you even see that in the current market right now, where we've got these big moves, and they're all happening this week. You know, they're not evenly spaced out.
So when the VAR is hitting that 1%, and does that mean the portfolio manager has to close some positions?
No, it doesn't. It's just, so the purpose of VAR doesn't actually tell you what you have to do. It just tells you how much money you're likely to lose on a normal bad day. So as to how you build your risk management around VAR is kind of a separate thing, and some people will be set up that way, where they'll basically say, you know, if losses reach a certain level, you have to start cutting or whatever else. But the truth is that VAR is actually just, the purpose of VAR is actually just to tell you, like, how does today's risk compare to yesterday's risk and a year ago's risk? And even to say, well, I'm running this type of firm and I have this level of VAR. Goldman Sachs is a VAR this much, Morgan Stanley is a VAR this much. And you can kind of compare the VARs of different firms and see the risk taking that's going on. But it really is just a measure of the financial risk rather than, there's not actually, what can I say, it's sort of like if a doctor says you're sick, that's different to them giving you a prescription. There's no prescription here, it's just it's just telling you what the losses can be.
How do you calculate the VAR?
Well, we're about to get to that. We'll look at this right now. So what I've done here is I just took the daily returns of the S&P 500 for 15 years and charted it. So that each of those lines is just one day. Then what we can do is basket them together and put it into a histogram, okay? And we do that, and that gives us something that looks a bit like a distribution. And then we're able to, on our next slide, look for the 50th percentile returns, so the worst 5% of daily returns. And in this example, I think it is minus 5.4% or greater, right? So in that example, for that 15-year period in the S&P 500, the 5% VAR, 95 VAR, is minus 5.4%. That means that is when you're in your 5% of worst days. It can get worse. So as you can see, the very worst day in that example was down 9%, you know. So that's sort of your range of swings within that left tail over that 15-year period. So that's one way of calculating VAR, which is simply to look at historic returns and find the 5% worst days or the 1% worst days and highlight them, and that is your VAR. Now there's another approach we have, which is the model approach. And the model approach requires us instead to look at expected, because that's a historic approach. If you wanted a forward-looking approach, you want to say, well, what does the market think the standard deviations are of these assets? And then we'll work out, using a normal distribution table, the 5% worst, most likely outcomes, right? So, where would we get a market level of expected standard deviation from? What might we find that? Is there anything we've learned in recent weeks about risk and about volatility that might tell us? Yeah, the volatility basically of an option, right? Implied volatility will tell you what the market thinks over the next short period of time. The distribution will be like, the standard deviation will be like. So if we take implied volatility of our assets, we can then look up on the normal distribution tables and see what VAR is. So we'll use this example. So if your standard deviation, or sigma, is expected to be 1.25%, so you've just taken that from the implied volume, you've worked out what the daily swing is expected to be, and we want to know what the one-day 99 VAR is, we just go to the normal distribution table and we look it up, and we see that that's 2.33 standard deviations to the left of the mean. And so that's just looking up what the 1% worst is on the table. And then that means that the 1% worst days will have 2.33 standard deviation loss. So 2.33 times 1.25 tells us what our 99 VAR is in that example, okay? So that is another approach. That's kind of an interesting approach. Both of these will give you different answers, right? So the historical approach will give you a different answer to the implied volatility approach. Now, the other thing that's interesting is, of course, as things start going crazy when you're using this approach, your VAR will start exploding, right? Because a week ago, when the VIX was reasonably low, you would have had a low VAR, and then all of a sudden, you're not actually taking more risk, but the market's assessment of the market's own risk is exploding upwards. We've got the VIX at around 60, 65 right now. Your VAR will explode when that happens. And so once again, there's no prescription. VAR isn't telling you what to do, but it is telling you that you've got way more financial risk on, even if your portfolio is the same, you've got way more financial risk on your books today than you did a week ago. And then it's up to you to decide how to deal with that. Does that make sense to you guys? Are we all happy with that? It's impossible to know if people are happy when they're wearing those masks. So, anyhow, so at least I know you're alive, though, you know, and that's what's one of my goals is that all of my students leave the class every day still alive. So the worst 1% of days should involve losses in that example of 2.91% or greater. Then if we multiply the size of our portfolio by that percentage loss, we get $1 VAR, right? So if you have $1 million portfolio and the worst 1% of days under normal situations will be a loss of 2.91% or greater, that means that you can expect to lose, we'll round it up, $30,000 or more on the worst 1% of days. Does that make sense? Okay. So, caveats to VAR. VAR does not describe the worst loss, and it's very important that we realize and understand that. VAR is just telling us that we're in a bad situation. We're suffering a normal bad day, is what it tells us. It doesn't tell us how bad it can get. It does not describe losses in the left tail. It just tells you you're in that area, but it doesn't tell you how far. You know, like I said, it's like you dive into the ocean. You know when you hit the water, you don't know how deep down the bottom is. It's measured with some error, and as you can see with those assessments, like the two approaches we took to working out what the VAR was, firstly, they're both going to give us different numbers, and secondly, you know, the question just even is what's the input, you know? With that 15 years of data, you'll get one VAR. If you use 5 years of data, you'll get a very different VAR, right? And so these are just tools that are sort of used to help, to give us a feeling for the situation we're in. They're kind of trying to get a number out of a messy amount of data. And it does that, but it's by no means perfect. And it assumes the portfolio is static, and that's kind of a big deal, right? Because if you have any sort of a portfolio where someone's trading in it, VAR doesn't really work. What about things like options? You know, if you've got a situation where you've either bought or sold an option and you're dynamically hedging and you're delta hedging that option. You know, if you take a snapshot of the portfolio, it will just tell you that you've got this position in the stock and this position in the option. And it doesn't take into account that as the price of the stock moves, you'll be adjusting your hedge, right? And so you'll start to see that we need different methods when we move to derivatives. Other flaws. So the normally distributed returns assumption is a flaw, right? It just is. And we kind of know about this. It's not really a secret in finance that there is this fat tail distribution of returns. And so VAR is not really telling you about what the sort of nightmare scenarios are. They're telling you, once again, what a normal bad day is. Like, that should be a bad day that you go home and you have a good night's sleep after. If you're staying awake all night, it means that it's worse than this. So what else have we got? The worst days can cluster, right? And we did see that in our chart back there, we saw how there tend to be these periods of stress and periods of calm. So that's quite different to what you might expect to see. And you're actually seeing it in the real world right now, where we're seeing these huge swings in the market this week that definitely weren't occurring a week or two ago. Right? So once things get bad, when there's one bad day, there tends to be another one. That's kind of an issue. And it drastically underestimates correlation in a crisis. Now, why does correlation matter? Does anyone know why it would matter? Who cares about correlation, right? The problem is that correlation has to matter because one of the big ideas in finance is that you can reduce your risk by diversification, right? And diversification means building a portfolio of uncorrelated assets, right? So if we had a bunch of assets, if we had 5 assets and we put them all in a portfolio, each of those assets happens to have an expected return of 10% and a volatility of 10%, okay? You might think that you would have a portfolio with an expected return of 10% and a volatility of 10%, but you won't. The expected return you can average like that, but the way you average standard deviation is different, and you have to take correlation into account. Now, the closer to zero correlation goes, the more diversification you get, and if you have negatively correlated assets, you get even greater diversification, okay? Now, that is great because that means that you might, in that example, the 5-asset portfolio, you might then have an expected return of 10% and maybe even a volatility of 5%, right? So on a risk return, you're always better off with a diversified portfolio rather than a single stock. But in a crisis, things tend to move together, So you have, when people get frightened, they sell all assets, So it's not just even financial, like it's definitely your stocks, right? Like, so if you might say, well, I own a coal mining company and I own an Apple computer, they're entirely unrelated to each other, except when everyone is terrified and then they sell everything all at once, right? And that's, there was a guy I used to work with who had a big art collection, and I said to him, oh, I guess that sort of diversifies your risk a little bit. And he said, no, not at all. Because he says, so if the stock market is down 10%, no one wants to buy your painting, No one wants to buy your classic car, no one wants any of this stuff, In fact, if there's a financial crisis, it's a good time to buy a boat and they're selling them cheap. So, correlation matters in a crisis. So, abuses of VAR, common abuses of VAR. The worst one here is referring to VAR as the worst case or maximum tolerable loss. And you do hear people saying that because they misunderstand VAR. They think that what it is saying is that this is the worst 1%. This is just telling you that you're in that area. It's always worse than that. It's very rare that you just go to the border, The next one is making VAR control the central concern of risk management. That can be a big problem at a lot of firms because if the truth is that the portfolio manager also should be a risk manager. Actually, a good story is a guy I worked with many years ago. I won't say the name of the firm, but he worked at one of the big investment banks. And one day, the guy who later went on to be the CEO of the investment bank walked by his desk and was talking to him a bit about his portfolio. And then he said, who risk manages this desk? And my friend said, Jim down the hall, he risk manages this desk. And the CEO looked furious and he shouted at him, you risk manage your portfolio, you risk manage it, And so when you have this idea that someone else is risk managing your portfolio, it's very problematic because that person, for one thing, might just decide that all their job is there's a number they see every day that's called VAR, and their job is to keep VAR low. That's not good risk management, right? Because all that will happen is you might get a whole bunch of traders who find the kind of trades that are risky but that don't show up on VAR, and they'll take those risks, right? So the risk manager has to understand the risks and understand why they're being taken and not just sit and look at their computer that gives this printout of what the risk is. Next one up here is assuming plausible losses will be some multiple of VAR, and you'll often hear, like I've met many people with like 20 years of financial experience, and they'll say, oh yeah, you know, VAR isn't the worst loss. Usually it's around 3 times VAR, you know. That's not what it means, you know, like when we're looking at a distribution, if you understand statistics and distributions, that's not what, you know, there's not sort of a rule of thumb multiple. Like the tails of a distribution are infinite, you know, so actually the losses are infinite, you know. So it's a misunderstanding of how the calculation works to think that. And then finally we've got here, reporting a VAR that has not passed a back test, you know. So your VARs actually need to be giving reasonable numbers, otherwise they've been incorrectly calculated, and that often happens, you know. So that is kind of our big abuses of VAR. Then we get on to criticisms of VAR. We have a bunch of kind of, I found every good criticism I could find of VAR. And you know, the truth is, I'm not in love with VAR as a calculation. It's problematic, but it's still something, and it has some uses. You know, one of our first criticisms is that it uses models built and implemented by non-traders without risk experience. I mean, that is an argument. I'm not sure that it's the greatest argument in the world, because someone can, you know, study risk and understand, you know, how markets work. I don't know that you get any special ability by having spent a year or two trading on a desk that you can't get from, you know, examining those trades. And it claims to estimate the risk of rare events, which is impossible. That's kind of sort of true, you know. It doesn't really, it's not supposed to estimate rare events. It's actually supposed to tell you what a normal bad day looks like, you know. So it's actually not, it's not designed to help you with these really shocking markets. Now the truth is people might use it that way, but that's a misuse of it. It's really just mainly to sort of help you track the overall risk in your portfolio and how it's changing over time. It gives false confidence. I think that is kind of true, because the problem is that when you give someone one number and tell them that's the risk, the problem is that people are drawn to that as an idea. What else have we got here? It created an incentive to take excessive but remote risks, and I sort of said that already, that one of the problems, if a risk manager is only going to focus on VAR, then you're going to have a bunch of traders who've worked out how to work their way around that, you know, and they'll basically expose you to risks that don't show up very well in your risk management system. Focuses on the manageable risks near the center of the distribution and ignores the tails. That's true. It's catastrophic when it creates a false sense of security. I think that is a big problem, is that sometimes, you know, people who don't fully understand the mathematics of these things, you know, they misunderstand what they're dealing with, and they think that they understand something that they don't understand. And so finally we have up here, easy to misunderstand and dangerous when misunderstood. You know, these are kind of good arguments. You know, there's a lot of the argument about VAR is, you know, people will say it's like driving your car while looking in the rear view mirror, you know? And that's true, but if you can't see out the front of your car, you know, you might as well look at something that you can get some information from. So it's definitely not perfect, but it does possibly have some uses. Time horizon with VAR. Well, if you take 1 day VAR, you could convert it into 5-day VAR just by saying 1 day VAR times the square root of 5 will give you 5-day VAR, right? That's just a simple calculation. So we're able to calculate VAR over various time periods. The formula makes sense, but is tied, of course, to this idea that we've normally distributed returns, which is a bit shaky. Historical VAR in practice. So one of the big problems with VAR is often when people look at a very calm market, they are surprised when things go wrong. And as you guys have probably seen, like if you pick up the newspapers, you know, people are all shocked by the kind of moves we're seeing in the markets right now because it was calm before. And that is, you know, that is a problem. But I don't know that VAR necessarily causes this. I think just people are not necessarily good at taking a very broad view of things. What else have we got? Time varying volatility. So this is kind of interesting. So in the standard VAR calculation, the volatility estimate is a constant. Now, one of the things that we can do in order to deal with this kind of clustering of volatility that we saw earlier is to use the Garch method, which stands for Generalized Autoregressive Conditional Heteroscedasticity, which is difficult to say. The daily vol estimate using Garch, what Garch does is it basically weighs the recent events heavier than the old events. So it's basically saying if things cluster, what we'll do is we'll say that yesterday's move is more predictive of tomorrow's move than the move from a year ago. So we're just going to heavily weight the recent events much more than the historic events. And that is a thing you can do that's kind of useful for dealing with this clustering of volatility. It's kind of useful, but it's also, once again, there's pros and cons to everything. In a very calm market, the problem is that you'll be overweighing the very calm events and not the, and then if things kick off, you'll be surprised. But, there is, the truth is you cannot see into the future, and you're using these, frankly kind of primitive tools to try and understand what's going on. But it's the best that there is, there's not really another approach. So let's now talk a little bit about distributions. I put these slides together because I think this is quite interesting. We all know what a stop loss is, right, in finance. We learned about order types, and there's an order type called a stop loss. And often a lot of traders will use a stop loss. They'll buy a stock, and then we'll say they put in a stop loss 2% or 5% below their entry point. And the idea is that if the market goes up, they'll make money, and if it falls, the most they can lose is this sort of 2 or 5% or wherever they put their stop. And this is, in many ways, I don't know, it's the kind of, it's almost like folk wisdom in markets, you've got to have stops in place, you won't lose money if you've got your stops in place, And it's kind of nonsense, like it's sort of something that I can only say unsophisticated investors believe in. So let's look at the idea. So a stop loss here, we've got this idea that will say if you bought the stock at this point, now you're hoping it's going to go up, but you've got a stop loss in that if the price falls by this much, that you're going to get out, right? So you won't ever lose more than this amount. And the idea is that you've got this big upside. So a lot of people who advocate the use of stop loss orders think that what it does is that it gives you a distribution like this, where essentially what they think they're doing is cutting off this left tail of the distribution, right? Because you can't lose more than the stop. In the real world, you also can lose more than the stop, because once the market goes through that stop order, it becomes a market order. And if the market is moving very fast, even if you had the stop, let's say 2% away, you might end up trading 3% away, for example, just because that's a thing that can happen. But a lot of unsophisticated investors think that what you're doing is just trimming off this left tail of the distribution. But of course, that's not what's happening. Does anyone want to tell me why that's not happening? What's the most likely thing that will happen if you put an order in about 2% away from the market?
Well, it's going to hit it really quick. And
it might get hit quickly, right? So let's look at that. So the next approach that people might think when they realize that is that maybe the most likely thing is that your stop gets triggered, right? Because what if the market is just sort of bouncing around and it hits your stop and you've lost 2%, And it hasn't tanked, it didn't then go down 30%, it just hit 2%, you were out, and then it's bouncing around going nowhere. Maybe even it goes up after that, right? So that is a likelihood, and so maybe the most likely event is this loss of whatever amount away from the money your stop was put. That's not what happens though. This is the distribution of returns you get when you are long a stock with a stop order in place. Does anyone think that that looks like a normal distribution? It doesn't, right? One person says yes, but I think they were laughing. So what we've got here is the most likely event is that your stock gets hit, okay? So the most likely event by far. And you are cutting out this left tail. Big chunk of the left tail is missing here. But you've also lost a big chunk of the right tail. Why have you lost a big chunk of the right tail? Why are you losing your wins?
Because you get stopped out before.
Yeah, because it went down 2% and then it went up 500%, you know? And so because you've got this thing in there that's really likely to be triggered, you know, it doesn't just stop the big losses, it stops the small losses, the big losses, but it also stops many of your gains, right? So that is the sort of hidden cost of the stop loss that people don't necessarily understand. But what's our takeaway from this? Well, our takeaway is, what if having a stop loss order in the books does that to your distribution? Do you think any of our derivatives have normal distributions, or even anything that looks like a normal distribution? They don't, you know? So how are we going to use something like VAR that assumes this normal distribution? Like even with stocks where we said there's a fat tail distribution, with a stop loss we've got this crazy distribution. All of our derivatives are going to have crazy distributions. How can we get VAR to work at all? Well, VAR can be very misleading in portfolios that include derivatives because they're not normally distributed, but we just have to do more calculation. So VAR won't take into account the gamma of a portfolio that includes options, for example. So one basic approach you could take is to calculate the delta of your derivative, and then you use the VAR method to work out how much the option will move if the underlying is normally distributed. That's one approach you could use. Does anyone want to tell me why that's not a great approach? Because delta hedging only works for small moves, right? So it's a bit better, but it's not hugely better. We've still got a problem because big moves are going to move us out of balance. So risk managers use the Monte Carlo analysis, or the Monte Carlo model, using volatility and covariance estimates for the derivatives underlying assets and the pricing tool. So essentially what you have to do is that you're able to model the underlying using whatever distribution you want in a Monte Carlo method, that then will price all of our derivatives, okay? So we're basically dynamically pricing the derivatives and working out what the actual distribution of our portfolio is, and then what a bad day in the stock market might do for our portfolio, or even what might cause a bad day for our portfolio. So we're able to use the Monte Carlo method, and we can apply it to portfolios with derivatives in order to calculate more reasonable VAR calculations. Well, when I say more reasonable, I mean reasonable VAR calculations. You'd have to use this with any sort of dynamic strategy. So we'll say, for example, even a portfolio of merger arbitrage stocks, for example, you'd use this approach, event-driven strategies, and even anything with dynamic trading in it. So as long as that dynamic trading can be known about in advance, so any sort of algo trading strategy would be able to use this approach. So, VAR risk limits example. So one of the things that you'll often see at trading firms, either at banks or prop trading firms or hedge funds or wherever, is a trader might be given a few different risk limits. One is often a VAR limit. They're told you are allowed to put this much risk on the books, this much VAR. And they might also be told things like, if you lose more than a certain amount, we're going to half the size of your portfolio. And if you lose another amount, we're going to close your portfolio out entirely. Okay? And so if a trader was told that they have a $500,000 VAR allowance and that they'll be stopped out if they lose $2 million in a month. By the way, being stopped out as a trader, it means that they close out your portfolio and then you take all your stuff and you go home and you don't come back again. So it's both your portfolio and you that are usually stopped out. So in volatile markets, big losses can cluster. We realize that both through the history we've seen and the week we have lived through here. And so a trader might under-lever their portfolio to avoid being stopped out, right? Because the trader wants to keep their job, okay? So what will happen in the real world is if you give someone with any real intelligence these kind of risk limits, you'll find that they don't come close to their VAR limit. They'll stay well away from it because their main concern is making sure that they don't lose 2 million in a month and then have to find a new job, which is never fun. What else have we got? So then we've got expected shortfall, and expected shortfall is also known as conditional value at risk, or CVAR. And basically, what that is the expected return on the portfolio in the worst cases. So what we're doing to calculate conditional VAR is we basically look at all of the VAR breaks that have occurred, we'll say using the historic method, and then we see how bad the losses were on those days, and we calculate the average of that. So conditional value at risk will always be a more conservative number, it'll be a bigger loss. So it's telling you what the average of losses, so not when you're in one of your 5% worst days, but it'll tell you in your 5% of worst days, the losses were on average this size. So it's kind of a bit of a peek into the left tail, where VAR just tells you where the left tail starts. What else have we got? Stress testing. I thought this was just the best image for stress testing. But anyhow, in addition to value at risk, financial institutions carry out stress testing. So stress testing means that as a portfolio manager, you might be told a VAR limit, you might even be told a stop-out limit, as we just discussed, but you also might be told that you have to construct a portfolio. The risk manager wants to know how much money you would lose on a day where the market fell 10% and the VIX doubled, or that type of thing. So basically they come up with an unpleasant market environment and they see how your portfolio would do in that environment. And that actually adds an awful lot of color. And where we're starting to go now, as you can see, is that with derivatives or in risk management, when we combine all of these approaches, we come to kind of maybe a useful understanding of risk. So we're able to have those sort of made-up market environments where someone just comes up with, what happens if correlation moved to 1 and the market fell by 10% and the VIX increased. All of these things. We can also just look at bad market environments, right? We can say, how would this portfolio performed if you held it on September 11, 2001? How would it have performed during the credit crunch? How would it have performed during the Fukushima meltdown? How would it have performed this week when everyone is about to die? And so when you combine all of these approaches together, you start to come together with a sort of reasonable approach to risk management where there's a bit of color to it. Now, risk management on the desk usually means that you're given a bunch of those kind of limits. If you work anywhere as a trader, you'll be given those limits. You need to understand those limits and how to work with them and how they relate to each other. But I've got up here that dialogue is more important than limits. And that's simply the idea that a risk manager's job is not to sit at their computer and to sort of, reach in and see portfolios and say what the VAR is on them or do any of these calculations. They will do these calculations. These calculations are good, but risk managers should be out on the floor talking to the traders and understand why they're doing what they're doing, right? Because if you have a portfolio that's sort of an engine that's designed to generate profits, the risk manager needs to understand the engine. They need to understand why the trader's doing what they're doing, what their goals are, what their plans are if things go wrong. And maybe even then, they need to, if the trader says, well, if losses reach this level or if this event occurs in the market, my plan is to change my portfolio. The risk manager is then able to come by and not say your VAR is too high, but say, hey, do you remember last week we said that, that should this merger deal break, your plan was to do this? Well, now we need to talk about doing that. That's kind of what good risk management is, rather than just a guy who walks around with a spreadsheet saying your VAR is too high. So dialogue is more important than limits, and risk managers need to understand what's going on. Operational risk is a big deal as well in the world of finance, and operational risk is just the risk of the operation continuing on, right? So, and actually that's kind of probably a big deal at most financial firms this week, right? I think I saw the other day, was it Morgan Stanley moved a team out to work in an off-site facility out near Heathrow Airport because of this whole virus situation. And so basically the idea is that there's also this business process situation where everything has to work. So I'll give you an example of a good example of operational risk is, we'll say for example if you're running an investment fund and you don't have a battery backup on your computer. That's an operational risk problem, okay? Because if the power goes out, you're no longer able to trade. But you need to have an off-site place to go to. You need to have maybe someone at a remote location who can close down the portfolio should it be needed. You know, investors don't like to invest in the kind of fund where there's just one person there, because if something happens to that one person, then you know, everything is a mess. And so actually in the world of investing, there's a thing called a DDQ, which is a due diligence questionnaire, which most, if you run a fund, the fund I run, I have a DDQ, and investors will often ask, it's almost the first thing they'll ask is, can you send me across a copy of your DDQ? And it's a whole bunch of standard questions that are asking, what are your plans for all of these different possible events that could occur? And so investors do really care, because often, basically with the idea of operational risk, they want the risk of the investment to be in the portfolio rather than in the business. You know, they don't want the risk to be that you know, some strange business thing goes wrong, like, you know, you get hacked or something like that and you lose your money. And so finally, in conclusion, successful risk management is in the details. You know, it's a very big field, and actually I'm probably underqualified to tell you too much about risk management, in that there are people who have devoted their whole lives to just that focus. But I do know something about it. The subjective component of risk management looms large, so it's not just about calculations. And you know, this is I love teaching this class, and I love all the financial mathematics, and I love getting you guys to understand that stuff. But it's always worth noting, you know, a lot of the mathematics that we use in finance, they're kind of borrowed from engineering and physics and adjusted to work in the financial world. And they're decent approaches, but of course, you know, once you've been around for a while, once you've used them for a while, you kind of know that they're sort of useful estimates. They're kind of like the weather forecast, you know. And it's important to realize that you know, one of the big constants is change, and that risk management is just really all about knowing what you're doing and paying attention to the details. So on that note, I'll end the lecture, and I'll see you guys hopefully next week.
Thank you very much.